Hello everyone, Luke Gromen, FFTT. Hope everybody's well and had a great weekend. I'm going to start off here, let's see, with the first question, a little bit light from GC. Do you think Major League Baseball should do away with the defensive shift? I've asked my son Connor to chime in on this, and he and I both agree, hell yes, they should, in our view. Either that, or I'm a big fan of using some of these speedy lefties to just start dropping bunts down the left field line there, make the pitcher come off the mound, especially those righty pitchers. They're falling to first. They've got to catch themselves, go get the ball, try to get the guy at first. So I'd like to see a little bit more of that if they don't outlaw the shift. So we'll see. Of course, I'm sort of biased since Khan's a bit of a pull hitter. So anyway, we're gonna jump into the macro stuff now from AI. Any recent changes to your views on crypto post your smartly deleveraging a few months ago? Also, do you see a risk of an everything rally resuming with put-call ratios up at high levels, the dollar perhaps turning down, etc.? Or are you in the caution ahead camp near term? Two questions there. In terms of changes to my view on Bitcoin specifically, no. I still own it. Have been buying a little bit back. Have also deployed some of those gains from back then into some other hard assets for my family in the ensuing couple of months. Likely will be buying more Bitcoin in coming weeks. Regarding the second question, the everything rally, I had not seen the elevated put-call ratios. That's usually a good contra-tactical indicator. In other words, people are buying more insurance on downside than they are on upside. And usually, at least in near terms, those are signs of some near-term potential upside in the indices. More structurally, I think we're coming to a key moment. The Fed's either going to go ahead with taper or they're not. And for those trading month to month, they've got to care about that. I don't trade my own capital month to month. And so for me, I'm really focused on that more structural dynamic. And the structural dynamic suggests the only way out of this in terms of these levels of debt globally and in the U.S. Is the continued more QE, more fiscal spending married together for longer and perhaps bigger than consensus thinks, and I continue to be positioned in that way. From WY, when you sold some Bitcoin before it dropped, did you use some of the proceeds to pay off your mortgage? Yes, to be blunt. Technically, if you look at it from a pure I don't know. Some of the Bitcoin maxis would tell me it's not smart, judging by historical Bitcoin returns relative to housing. I would agree with them. I think from a political standpoint, though, which is how I was looking at it from political economics, housing, real estate is a politically acceptable inflation hedge. Bitcoin is not, as we've seen from some of the rhetoric from certain policymakers in recent months. I didn't want too much of exposure to one versus the other. The other thing, too, and it's just sort of philosophical, which is if you're in debt, you're truly not fully in control of your own life. Once you're out of debt or largely out of debt, you're much more free. And practically speaking, it doesn't really change anything day to day. For me, it's more, quite to be blunt, it was a nice feeling. So the other thought process on that, too, was really worst case, if Bitcoin is regulated away, if something happened to it in the short run, in the long run, I don't think there's a lot the regulators can do about it for reasons a number of the Bitcoin folks have talked about a lot. But in the short run, from a regulatory perspective, some of that risk, I figured worst case, you get a lot of the house paid off, and that's not a bad thing. So from Spock, do you think the Fed will actually taper in the next 6 months or so? Or use the Delta variant and weakening consumer sentiment, etc., to kick the can down the road a little longer? In my opinion, it's the latter. I think they've got a window now with the Delta variant and the indices, consumer indices rolling over in part due to those, to say, hey, we need to push out taper. It's not our fault. It's Delta. So I think that's what's most likely to happen. I think that's a bit of a contrary view still. Maybe now with the Fed going to virtual meeting for Jackson Hole in a couple weeks, that may start to become less of a contrary view. Let's see, from Mike G. You've said to expect real rates to be extremely negative going forward. What type of political climate do you expect to see when inflation roars higher and posted rates never move to offset such? Would that not mean at some point politically negative real rates not being negative real rates means politicians not being reelected, which would mean that at some point responding to very negative rates might become a political necessity, negative real rates. In my opinion, we're seeing it, how they can manage that process. In other words, it depends, in my view, how good the politicians are, how good the propaganda is, how distracted the populace is. So if the politicians are tactful and the propaganda is good and repeated enough, inflation is transitory, inflation is transitory, inflation is transitory, and the population is distracted sufficiently by fear or by divisive rhetoric or by other soft issues, social issues, then I think they can get away with it for quite some time. And I think the other thing to think about in this is it's a suboptimal situation, but at this point they're all suboptimal choices. And so it's really, is trying to do this likely to pose, and this being negative, significantly negative real rates, high inflation, is that going to pose more political risk to the politicians, or will cutting entitlements and implementing austerity on the populace pose more risk to the politicians in the more immediate term? And I think the answer is highly likely that it's the much bigger political risk to politicians getting reelected is to try to implement some sort of austerity. So I think they're going to kind of keep running this playbook of kick the can down the road, inflate it away, tell you they're not inflating it away, and see how long people will believe it or remain distracted to not really notice. And so far, so good. They've done a nice job. From Sam, with the Feds looking to taper in the next couple quarters, would it be a good idea to short 20-year Treasury bonds? In my opinion, no. I would not short Treasuries except for the Finance 101 way, which is borrow the money at a fixed rate for as long a period of time as you can. Not too much money on some sort of productive asset. Ideally, that's cash flow positive, something like farmland or some sort of niche real estate that you could rent out to somebody else, beach house or rental properties, things like that. From CT, will Basel III, the net stable funding ratio for gold, be fully implemented to remove precious metals derivatives risk from the banking system, or will it be sidestepped with exceptions? That's a key question. I don't know. I had hoped yes. The LBMA carve-outs that we saw rolled out, I think it was about a month and a half ago. Was the first indication that maybe they will basically carve out things and reduce the effectiveness of it. I've not seen enough information yet to have a great feeling for it. Both Alistair McLeod and my friend Bob Coleman have written pieces noting that you're still moving towards a more physically driven market. It's just happening more slowly with these carve-outs, and so hopefully that remains the case. Obviously, anything that reduces unallocated gold leverage over time should be good news for gold prices. Basically, if you stop letting the increase in unallocated gold be the release valve for gold demand, then the price of gold starts to be the release valve for gold demand. So let's see how that plays from here. From BF, can the USA afford another war given our debt levels, assuming a bad escalation in a major area? Not some skirmish. I'm talking broad-scale war in the Mideast. The short answer is yes. We can print the money. So in my view, it would be a question of how bad the inflation would be. The worst case would be a hot war with China, in my view, and Fed prints the money for the war effort. But China stops the boats. China's ports stop shipping to America. And if that happened, then U.S. store shelves would probably go empty within weeks, if not days, while the Fed is printing money, or the government's spending money and the Fed's buying the debt, which is effectively printing money. That's Ben Bernanke's helicopter money. It's what we did for the last 12 months up till April or May, excuse me. At any rate, you'd be talking about borderline hyperinflation in some areas in the United States in those cases. And so when I kind of talk through it out loud, I think the premise of your question, I think, is valid, which is, in my opinion, the combination of very stretched supply chains, many of which go back to China, who in theory might be an adversary under said circumstance, along with the levels of debt outstanding, let's say they definitely would reduce some of the optionality. You'd have to put severe economic rationing in place in the United States. You'd have to have some sort of Manhattan Project to ramp up industrial capacity. All of these things would be extraordinary inflationary. The good news is the debt would get inflated away remarkably quickly. It'd be great news for basically everybody but debt holders. So it's an interesting question. I appreciate it. From MH, is the Afghanistan pullout part of a larger trade, quote-unquote trade, taking place between U.S.-led West and Eurasia? Political black eyes aside, timing along with Nord Stream 2 and other big-ticket moving parts seems very relevant. It's a great question. I don't know. I suppose it possibly could be. It definitely seems to have driven, even in the past week and a half, a significant change in perception happening, even amongst the friends of mine that I would lump into the King Dollar because of our U.S. military crowd on FinTwit. Hey, we're the reserve currency and it'll always be King Dollar because of our military. And I think our military is still very, very good. I also think that to me, it should change perception in a way. And how I would phrase this is it would seem that any great power competition war would quickly go nuclear. And so then it turns into a question of who's got more nukes. And I say that because the tactical, conventional side, obviously, guerrilla wars are really hard to win, which is ironic that we have to keep learning that as a nation that was founded by defeating the world's greatest empire in a guerrilla war. Separate issue. But that's the side of it that I'm watching more, is really just this view that basically if the only war possible is a nuclear war, that's uninvestable. So then we can say, okay, the power dynamics that existed prior to 2 weeks ago in people's mind, in the perception, are they shifting? And I think your point's well taken. I think they might very well be. I think there might be some other things at work when you look at Nord Stream 2, for example. The U.S. backed down after 15 years of trying to stop this thing. Is that because there is a fossil fuel supply issue coming up in 2 or 3 years, and asking our allies in Europe to freeze in the dark is not a politically defensible position? I think there's something to that we're looking at some fossil fuel supply shortages potentially, or supply issues, supply demand issues in certain areas as we look out 2 to 3 years. So we'll see. Peak cheap oil is something we've been writing about quite a bit in recent months, for example. Okay, next question. Let's see. 2 last questions. Do you envisage a situation where the U.S. breaks apart in a similar manner as the USSR, with states becoming individual entities, or perhaps 2 separate federations of states, a sort of right and left leaning? No, I don't think so. I am seeing the political fragmentation happen in real time. I think we all are. I think it's sad to see, and I don't even think it's within states. I mean, it is between certain states, but I'm seeing it in families, communities, and it's unfortunate. So I don't think it gets that bad, but I do think that there's some political disruption that could really come to a head in coming weeks in the United States, with the vaccine mandates coming to a head in a number of places around the country. And then the last question, the reverse repo, thoughts on that? Yeah, the way I think about the reverse repo is it's effectively an Enron-like special purpose vehicle to help the U.S., help the Fed, help the banks, finance the government while keeping the banks in regulatory compliance with Basel III. And what I mean by that is, this is dating myself a little bit, for those of you that remember Enron back in the late 90s and 2000s, one of the things they were doing is every quarter end, they would have these barges, I remember, and they would repo the barges back to one of their brokers. And so the barges would be off balance sheet at quarter end, and then they'd come right back on the first day of the next quarter. And so the balance sheet looked better than it was, is the point. And so the point here is if we just look at the flows, if government spends the money, Treasury issues treasuries to sterilize those flows to some degree, U.S. banks buy a good chunk of those treasuries, The Fed buys those treasuries off the banks. That creates reserves. That's fine. However, once bank reserves hit a certain level, that begins to be a problem for the banks under Basel III. And so when the Fed does the reverse repo, they reverse repo treasuries back to the banks to sterilize the reserves that were just created by the Fed buying the treasuries from the banks. And I have it on very good account that that's all off balance sheet. Those reverse repos are off balance sheet. So the banks are in compliance with Basel III. The treasuries are still getting placed with no disruption. The government's getting their money. Everybody's happy. What could possibly go wrong? So for me, I don't think reverse repo is necessarily the deflationary impact that some have said. I think it's more a financial engineering at the sovereign level to continue the inflationary financing of the U.S. government deficits by the Fed and the U.S. banking system. So with that, I want to thank everybody for joining me for tonight. It's always great catching up with you, as always. If you're interested in getting more of these types of updates, check out FFTT-LLC.com for information about our Tree Rings product, 10 most interesting things, different synopses of each, lots of different topics, get great feedback on it. So hopefully everybody has a great week. I look forward to catching up with all of you soon. Stay safe, stay healthy out there, and take care.